SoFi's Q2 earnings call just came in, and the CEO, Anthony Noto, dropped some interesting little hints about SoFi's killer edge. This edge, according to Noto, may be the deciding factor in the battle against the legacy banks, which by the way hold over 500 million accounts. If you combine the market cap of just the top 5 legacy banks in the United States, that would total over $1 trillion in market capitalization. SoFi's market cap is currently only around 14 billion at the time of recording this. Put simply, if SoFi takes only 15% of that $1 trillion of market capitalization from the legacy banks, that would result in over a 900% return from where it is today. Now, what does that mean for the average investor? Hypothetically, let's say you invested $10,000 in SoFi at its current market cap, and it did manage to take that 15%. You would then have over $100,000. In this video, we'll go over all the juicy information that you may have missed in SoFi's Q2 2021 earnings call, and ultimately reveal what Anthony Noto sees as their ultimate weapon against the legacy banks. Lastly, we will go over whether or not, in our opinion, we think that SoFi has the ability to actually absorb 15% of that $1 trillion plus worth of market cap of the top 5 legacy banks. Please note that we are not financial advisors and this is not financial advice. Please always do your own due diligence. And if you enjoy this content, please smash that like button for the YouTube algorithm. Also, consider subscribing if you want to see more videos like this. Anyways, without further ado, let's get right into the video. Here are some of the bank's problems. The legacy banks, similar to the legacy automakers, have become complacent and are no longer willing to innovate. Don't get me wrong, a couple of micro improvements here and they do come out from time to time, but they are limited. The limiting factor is their infrastructure. Have you ever wondered why the average interest rate on a checking account is around 0.1% to 0.3%? That is because the banks need to pay for all these brick and mortar locations. Not only that, but the locations need to be staffed, and that too costs a large amount of money. To take it a step further, the staff at all these locations need to be managed, so you need to hire people for that. If there's one thing we learned in 2020, it's that brick and mortar locations are extremely vulnerable. Another thing that we learned in 2020 is that the future is digital. The companies that are best positioned to leverage technology to serve a larger market in all parts of the world and at a significantly more cost-efficient price will win over any brick and mortar business. Here at Wealth Gambit, we think that the banking industry will be disrupted, similar to how the legacy automakers were disrupted by EVs. The company to do that disrupting, we think, will be SoFi, along with the other fintechs. These companies are able to leverage technology to basically do what the banks do, but cheaper. I know what you're thinking. Why don't the banks just copy the fintechs and beat them at their own game? Well, it's not so easily done. In order for the banks to compete, they would have to close down almost all their brick and mortar stores, fire all those employees, and invest heavily in technology, which, by the way, they're trying to do. Wells Fargo, for example, has seen its physical locations decreasing over the past several years. JP Morgan Chase is investing heavily in technology. Let's take a look at their expenses. You can clearly see here that in terms of their non-compensation expenses, technology, communications, and equipment is by far their largest expense, coming in at $10.3 billion in 2020. You can also see that this has been trending up even over the previous years. SoFi, on the other hand, was built on the back of technology and innovation. In fact, Anthony Noto said in the Q2 2021 earnings call that SoFi continues to focus on iteration and learning, which then leads to compounding innovation. Wow, compounding innovation. What company does that? And how did that go for them? You guessed it. Tesla. By the way, how is Tesla doing in relation to the legacy automakers? Oh yeah, that's right. Tesla has a market cap larger than the combined top 9 automakers in the entire world. SoFi, according to their chief financial officer, Chris Lapointe, had a net income of about negative $165 million, which may seem bad, but according to Chris, this in large part is due to some one-time transactions. But still, again, we know what you're thinking. Losing millions of dollars, no matter what the reason, is never good. And we here at Wealth Gambit agree with you, but not all losses are created equal. Losses that are accompanied by massive amounts of growth are not so bad, at least in our opinion. Anthony Noto talked largely about the fact that SoFi is blitzscaling, which according to HarvardBusinessReview.org blitzscaling is what you do when you need to grow really quickly. It's the science and art of rapidly building out a company to serve a large and usually global market with the goal of becoming the first mover at scale. Now, why would SoFi need to grow so quickly that it at times loses money? Do remember earlier when we talked about how the legacy banks have already started taking steps in this direction? The only problem is that they have decades upon decades of infrastructure built out that they need to untangle themselves from if they want to have a shot at competing. Let's take a look at Tesla, because they did something very similar. At first, they were aggressively scaling so much that they were absolutely burning through capital and everyone laughed. EV vehicles that were technologically superior would never become the future. Now look at Tesla. It has been profitable for the last 4 quarters, and the running at break even to a loss in those early years has gained them a technological head start of 3 to 5 years, depending on who you ask. Now, imagine what Tesla would look like today if it had instead focused on profitability in those earlier years instead of growth and innovation. SoFi is on that same exact path. Let's listen to Anthony Noto to see where SoFi money is going.
The last point I'd like to drive home today is that we continue to invest aggressively in our business to fuel compounding growth while still delivering profitability to our shareholders. This combination is not easy, but we are committed to contributing around 30% of incremental revenue to the bottom line and reinvesting the remaining 70% in bolstering our product innovation to drive decades of compounding growth.
And growing it is. In 2021, SoFi's members grew 113% in year-over-year growth, totaling 2.6 million members. Along with that, they achieved record-adjusted net revenue coming in at $237 million. And this was despite one of the major business legs, student loan refinancing, operating at 50% pre-illness levels. This is due to the CARES Act, which turned interest rates to 0% for all federal student loans for the time being. To summarize the Q2 earnings call, almost everything that is good got better, and almost everything bad became less. Anthony Noto also talked about how no other company that they are aware of is a one-stop shop. This then gives way to what Anthony Noto called SoFi's greatest competitive edge. Let's go straight to the Commander Noto for the inside scoop of this one. This is what we like to call a SoFi shareholder's wet dream. Just kidding, not kidding.
Yeah, the biggest competitive advantage we have is that we have a superior lifetime value. We have that superior lifetime value for a couple of factors. First and foremost, we're a one-stop shop, and so we're building best-of-breed products. So when someone needs a product, we're there for them, whether that's a big financial decision or something that they're going to do on a daily basis. And when they use that first product, we build trust and reliability with them. So then when they use a second product, we're there for them. When that happens, not only do we generate more revenue from that relationship, but we have compounding profitability benefits because we're not paying a second customer acquisition cost. So in our loan business, as an example, we've had variable profit in the range of $800. When that product gets cross-bought, that $800 doubles, which we outlined in our management presentation during the roadshow, because we're not incurring a second acquisition cost. That lifetime value is really unmatched by any of our competitive set because, one, they don't have the range of products that we have, and two, many are not in the lending business. And because we have that superior lifetime value, we can then reinvest the excess profit compared to our competitors in better rates, better prices, no fees, better service, better selection. And it just drives the overall flywheel of our business. And when we say we're seeing an inflection point there, we are seeing the benefits of it across lower customer acquisition costs, lower sales and marketing as percent of revenue overall. And as you saw, significant acceleration in the number of products we have and the number of members that we have. In terms of the competitive landscape, no one else is really doing it. Everyone has talked about it. I arrived in January 2018. We talked about our strategy. Others have talked about trying to become a one-stop shop, and no one's gotten there.
Well, there you have it, guys. SoFi's killer edge.
Great success.
If you got any value from this video whatsoever, please smash that like button, as it does take a considerable amount of time to make these videos. Do it! We really appreciate it. If you want to see more videos like this, hit that subscribe button for more weekly SoFi content, among other things. That about wraps it up for this week's video, guys. Let us know in the comments down below if you agree or not. We reply to every comment. Until next time, peace.